Good morning. Happy Friday. Welcome to Stock Market Today for March 5th, 2021. This is Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter. I'm at Dan Russo _CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for an email where I get a lot of the content for this show. We also give you ideas to consider. It hits your inbox every trading day before the market opens. So U.S. equities finished lower on Thursday, and the NASDAQ composite is now down on the year. Growth and momentum underperformed as rates moved higher on the day. Energy was the biggest gainer, and defensive sectors also led. Technology and materials underperformed. Treasuries sold off with the curve steepening. The dollar was stronger on the major crosses. Gold finished down 90 basis points. Crude oil settled up 4.2%. Remember, there was an OPEC meeting yesterday. As we get to the desk this morning, S&P futures are up 30 basis points after Asian markets were mostly lower overnight. European markets are trading weaker, and treasuries are, let's call them unchanged here this morning. Dollar is extending its strength on the major crosses. Dollar's up over 1% on the week. Gold is down 30 basis points. WTI crude is up 2.5% after rallying more than 4% yesterday. And on tap at 8:30 this morning, non-farm payrolls will be in focus. According to FactSet, estimates call for an increase of 175,000 jobs in February. That's the backdrop for markets that are now at an inflection point. So it's kind of interesting that we're at an inflection point and we're going to get a key data point for the economy today. The rationale behind calling this an inflection point is quite simple. SPY is now in the support zone between 370 and 380. That is the range in the near term that we have been highlighting. It's in play now. Below that, 340. The Qs, 300 is now key. We took out near-term support on the Qs. We're watching that 300 level closely. I think that is the key marker here in the near term now, above which we can say the structure of the uptrend is intact but wavering, as we started to say yesterday, but still intact. We break 300, we have to start thinking about a different roadmap, at least as it relates to the Qs. Now, part of that roadmap has been playing out, quite frankly, as the cyclical value rotation reopening, call them what you want, ideas have been working in the face of weakness in the growth theme, especially mega cap and especially high multiple growth. So the roadmap, in fairness, has been shifting. But 300, I think, is the key level here for Qs. We tested it yesterday and then rebounded from it to close at 304.10 on the day. IWM still a little bit above near-term support in the 200 to 210 range, closing at 213 yesterday. And then below that, 160, 170 becomes key. I still see upside potential to 413 for SPY. Is the trend wavering here in the near term? Yes. Is it broken in the near term? No. All right. I think that's an important distinction to make. We are at an inflection point. We're going to get a key data point today on the economy with non-farm payrolls at 8:30. So I think at this point, you kind of sit back, see how it plays out. The market will dictate direction. The market will tell you which roadmap to pull out of the glove box. The trend is now wavering, but not broken, is my view here. If you had to give me, if you had to pin me down on a one-sentence view of the overall equity market here in the U.S., I would say the uptrend is wavering, but not broken. Let's touch on our market in a minute now. Powell fails to soothe growth stock investors as Qs test key 300 level. Rates continue to rise, adding to the growth stock pain trade. Semiconductors breaking down on a relative basis. We're asking the question. We'll take a look at that a little bit later on in the show. High beta remains stretched versus low volatility, and futures are pointing to a higher open today with the jobs report on deck. Let's take a look at the major indices now from a power bar perspective. Dow slips negative, 6 bulls to 7 bears after losing 1%. S&P 500 down 1.23%, 115 to 65 bulls to bears there. The NASDAQ down 1.64%, 12 to 25 bulls to bears. So greater than 2 to 1 on the bearish to bullish side of the coin now for that ratio on the NASDAQ. Small caps, your big underperformer on the day, down 2.7%. Still a solid ratio. Bonds down tick, sending yields higher. Energy, once again, your best sector on the day, up 2.4%. 7 bulls, 0 bears in the energy complex. According to the Chaikin Power Bar, small cap stocks and large cap stocks are bullish. Major indexes across the board are mixed. Let's take a look at our stock of the day now. Berry Global Group, ticker symbol BERY, closed at 57.83, down 76 basis points yesterday. So we can call it an outperformer. Has a bullish Chaikin power gauge rating. The trend is strong and part of a strong industry group within the containers and packaging area of the market. Trading above the rising long-term trend line. What jumped out at me on this stock was right here. The spike in relative strength in the face of equity market weakness over the past couple of weeks is interesting to me. I always find it helpful to search out the areas of the market that have held up the best when the broader averages get volatile. I think that oftentimes can be a great starting point for new ideas. Taking a look at the overbought, oversold indicator here, rounding out of an oversold condition with bullish money flows. We have a bullish fund outperforming with the intensity of outperformance picking up of late. Moving from oversold with bullish money flow as it consolidates above support and above the rising long-term trend line. That's an interesting setup to me. Definitely warrants some attention here for investors who might be looking for new ideas. Taking a look at our sector tracker now, the movement of the major sectors over the last 5 days. Energy at the top of the list. And I think that following price, having a process, and focusing on relative strength really shine here, because energy has been a disaster was a disaster for a long time. We were bearish on it. There was probably a 2-year stretch where I just didn't have anything good to say about energy. But that changed in December. And rather than remaining dogmatic, rather than, pointing to things like, well, President Biden is for clean tech and we had a blue wave in Congress, and clearly this is bad for traditional energy. No, we followed price, we followed relative strength, and got on board. I think that dogma is probably one of the worst traits for an investor to have. When the facts change, changing your mind often makes the most sense, and that's what's happened here. And energy has worked higher. Comms and financials also higher over the past 5 days of trading. Industrials, materials, utilities, and staples in the middle of the pack. Healthcare, tech, discretionary, and REITs at the bottom of the list over the past 5 days of trading. Obviously, tech and discretionary are in focus here. Tech is, hardware, semiconductors, software, a lot of high multiple names in there getting hit. The discretionary, I think, is really a play on the same theme, in that Amazon and Tesla are now the largest weights within that sector. Hitting our industry in focus now, Dow Jones REIT Services past 6 months has outperformed the S&P by 50 basis points. Power bar ratio, negative 22-8. Bears to bulls there. Currently ranked number 18 of 21 subsectors, though it has moved up 2 slots over the past week. So QTS Realty is very bearish. Realty Income Corp is very bearish. And Duke Realty, DRE, is very bearish. The fund itself, little near-term outperformance, but largely a nothing over the past year of trading. Perhaps maybe some of the near-term outperformance are investors rotating out of treasuries, low-yielding treasuries that have come under pressure, and maybe they're attracted to the dividend yields on some REITs. I don't know. I haven't dug that far into it. Realistically, the trend here is flat, right? It's pretty simple. Here's a year ago, here's today. The textbook definition of a nothing burger. Just flat over the past year of trading. Near-term outperformance, okay, maybe something to pay attention to, especially should it persist while equities remain weak. That'd be a defensive message, something we'd want to pay attention to. But right now, it's early days. We're going to watch it. Trend is flat. Let's take a look at what's trending now. Our yesterday's gainers and losers, our movers and shakers in the S&P 500. And if you focus on the left-hand side of this screen, I think the message is pretty clear as it relates to what I was saying earlier about energy. So yesterday, OPEC meeting as it relates to production levels, takeaway was bullish for oil, bullish for these energy stocks. Clearly, Diamondback Energy, FANG up 9% on the day, EOG up 6.6%. Nothing company specific here. I think it's just kind of a thematic trade in energy, oil, and then you had an OPEC kicker yesterday. Marathon up 6.3%. Hess, I'm going to call it Amarada Hess Corp, 466 to the good, and Oxy Petroleum, 4.33% to the upside yesterday. Taking a look at the loser side of the board, Tyler Tech Tyler is a growth stock, certainly. And they announced the convertible offering yesterday to take 13.5% out of the stock. Western Digital, WDC, down 8.9%. Enphase, ENPH, down 7% on the day. Freeport-McMoRan, no news, down 6.5%. MOS, Mosaic, part of that ag theme, although we did get some USDA sales data out yesterday. Mosaic down 6% on the day. I will note Western Digital did catch an upgrade. WDC caught an upgrade at Goldman Sachs here today. Let's dive into the charts now. Taking a look at what's going on here on the growth versus value trade. Sorry about that. On the growth versus value trade, IUSG versus IUSV, breaking down below the 200-day moving average, below near-term support. All along through the consolidation, we were getting a series of lower highs on the part of the RSI, right? So from a momentum standpoint, we can see that momentum has been waning, and we're now pushed into an oversold position. Similar dynamic at play, although not a breakdown yet on the QQQ versus SPY ratio. So just something to be mindful of here as we're watching. As I said earlier, Q's at an inflection point. There's no doubt about it. Next couple of days are going to be important for that QQQ, the NASDAQ 100 ETF. But growth versus value after a solid first kind of 8 months of 2020, peaked out September 2nd, went into a consolidation and is now breaking down from that consolidation below the 200-day moving average. Notice too that the 200-day moving average has gone from rising to flat. So clearly the trend has changed here. The question is, what happens on rebounds? Does a rebound just kind of take us up to the breakdown level and fail? That would certainly be a change of character for this ratio and would tell you that, yes, the growth over value trade is likely over. So it's something that we want to be watching closely in the days and weeks ahead. Taking a look at semis on a relative basis, breaking near-term support, still above the 200-day moving average. Now, remember, my big kind of gripe with the semi relative to SPY ratio is that for a long time, it's just really extended from the 200-day, over 20% above the 200-day moving average on the ratio here. We're down to less than 10% above on the ratio. So I think that's important. Taking a look at the bigger picture trend, still up. Near term breakdown. No two ways about it. That is what's happening. RSI, after failing to become overbought on the most recent spike higher, which also left a negative divergence. Notice how we have the higher high here for the ratio, but the lower high on the RSI. And RSI is now pushing on a string at the bottom end of bullish ranges for this ratio. So something that we're going to be watching closely. Remember, we pay close attention to semiconductors as a read on the broader market, especially kind of the momentum of this ratio. When semis are outperforming, that's generally positive. But when momentum starts to waver in this ratio, as it has been for pretty much this year, it could lead to some choppy trading for the overall equity market, certainly for the tech space, and we've seen that play out here over the past few weeks. So let's keep this ratio front and center. If you are bullish, right, ideally what we want to see is the Qs hold 300, and we want to see this ratio get back in gear. That would be a bullish development for investors here. And then finally, Treasuries. We highlighted this support zone yesterday, last Friday. And realistically, we're holding it still, right? Notwithstanding the sell-off in rates yesterday on the back of Powell speaking, we're still holding this support zone. So I think the mosaic is clear here. I think you want to see Qs hold 300 while this bounces. So IEF holding kind of 112 to 114 while the Qs hold 300. That'd be an important development in the marketplace. Should these levels break, we have a new dynamic at play in the market. I think today and the next couple of days are going to be real important, especially watching this, watching rates here as well, right? Rates have backed up to 1.5 on the 10-year. So that's going to wrap us up for today. I hope everybody has a great weekend. Head over to ChaikinAnalytics.com/test drive to take us for a spin. I'll talk to you Monday.